These are the most important things that you should know before you go out and get a permanent life insurance policy. So maybe you're looking to build some safe guaranteed wealth down the road, maybe you're looking to pay off some high estate taxes, or you're looking to replace your income in case you didn't come home so that your family can be protected. So the first thing you should know is that there are different types of companies out there. The first type of company is a mutually owned company. That's a company that's going to be owned by its policyholders, and when they make decisions, it's going to be in benefit of their policyholders, and all of their profits that they earn, they're actually legally required to pay them back in the form of dividends back to their policyholders. The second type of company is going to be a stock-held company. That is a company that has shareholders, and just like any other publicly traded company, they have to make decisions that are going to be at the benefit of their shareholders. Additionally, they are also going to be paying dividends to their shareholders as well too. The second thing you should know is that it's important to go with a company that pays dividends. Not every single company out there pays dividends, and you can think of dividends like interest in your savings account. Let's say you get a savings account with an interest rate of around 0% versus a savings account that has an interest rate of around 3.5% or 4%. It's going to make a pretty big difference in the long term how much capital you build up, because that additional interest that you're getting in that account helps compound the money that you're saving. So in that same regard, insurance companies are going to have dividends that they pay out, or some insurance companies. So those dividends are going to be paid out, and they're going to help build up your cash value and your death benefit in the long term. The third thing that you should know is it's important to pay attention to the financial strength ratings of a company. So you can think of financial strength ratings as essentially like a credit score. If someone had a 600 credit score, the probability that they're going to pay money back that you loan them is probably not too high. As opposed to someone that has an 800 credit score, if you loan them money, you're pretty sure that they're going to be able to pay that money back when it's due. So insurance companies have the same or very similar type of rating. The rating agencies, one of them is actually Standard & Poor's, and they will rate these companies based off their financial strength. So if you want to make sure that you're going to consistently get dividends over the course of time, and they're going to be able to pay off that death benefit, it's important to go with a company that's a high financial strength rating. The fourth thing you should know is whether or not you're looking to maximize your death benefit in the policy or your cash value. So if you're looking to maximize your death benefit in a policy, you want really more of the money that you're paying to go towards paying for additional death benefits, so going towards that base premium on the policy. However, if you're looking to build up cash value, you actually want money going towards the paid up additions. And you can think of paid up additions like additional mortgage payments. Those paid up additions are going to go straight into the cash value in your policy, building that policy up faster and accelerating the growth in there further. The fifth thing that you should know is that there are different types of permanent policies out there. There are whole life policies, index universal life policies, and variable life policies. These different types of permanent policies all have different characteristics to them. Some of them have guarantees, some of them don't have guarantees, some of them may be tied to some indexes like in stock or actually directly invested in stocks. So it's important to understand again what your goals are and what you're trying to accomplish before you go out there getting a permanent policy, and also making sure that you're working with an advisor that is willing to take the time to understand specifically what your goals are, so they can make sure that they're designing something that really aligns with what you're trying to achieve. I hope this video was helpful, and if it was, please feel free to like and comment if there was something in here that helps you, go further in building your own wealth, and also share this video with someone who you think may also benefit as well too.